We were talking for a number of weeks now. I've been bringing, and you know it, I don't have to tell you, but the inflation problem and the supply chain problem that we have in this country, which is only getting worse week to week. And we're seeing major inflation issues, not only here in the United States, we're seeing it worldwide. And there's a number of reasons for it. You know, COVID part of it, which really affected, employees. There's employee shortages worldwide, which I still don't understand. Here in the United States, the federal subsidy for unemployment ended in early September, and we would expect that all these people who were sucking up the unemployment and making more money staying home than going to work was going to go back to work at that point. And it was announced this week on Friday that the job numbers in September was a disaster. That instead of 500,000 people getting jobs and the economy adding them, only 194,000 jobs were created in September. I thought for sure we were going to overshoot the 500,000 as people say, okay, I'm off the dole now, let me get out there and start working. It hasn't happened. And a lot of economists are scratching their head wondering why. But anyway, go back to inflation. It's supply chain issues. It's worker issues. Big issue in shipping with truck drivers are in short supply. We'll talk about that in a little bit. And we're seeing shortages about almost everything. Now, I was in, and the things that you can get are very expensive and going up daily. I was in Costco yesterday. First of all, they were out of toilet paper. Meanwhile, Costco is limiting one package per person on a number of items. No toilet paper, 11 o'clock in the morning in Costco. So here we go again with the toilet paper thing. But I was standing at the meat case in Costco, and I'm just watching people, and they pick up a thing of steaks or whatever it is, and 50%, if not more, were putting it right back because the price was so high. I was looking at $28.99 for steaks per pound. Right? And I was finding myself doing the same thing. I'm like, I ain't buying this. I mean, I can afford to buy it, but I'm not paying that crazy price for that. And I can only imagine people who are on a strict budget or on fixed income and look every day when they go to the store at how more expensive everything is. And if it's not more expensive, you're getting less per package. Shrinkflation, as we call it. It's really tough thing, inflation. And it's accelerating. Now, part of it's all the money printing that's been going on, not only here in the United States, around the world. Part of it is post-pandemic. Well, it's not post-pandemic yet. I don't know if it'll ever be post-pandemic. Of course, we got COVID craziness to talk about later in the program. But it is people, there's some pent-up demand for things and so forth and so on. But, inflation is here to stay. It's not transitory as the Federal Reserve wants you to believe. The Federal Reserve and other central banks are not raising interest rates to battle this inflation as they should and as they have in the past. They are just accelerating it by lack of action on interest rates, lack of action on tapering their quantitative easing program where they're printing $120 billion per month. We have the United States government. They just raised the debt ceiling this week. We'll talk about that later on. By the way, the stock market liked that. The stock market went up that day. It's kind of crazy if you think about it. Yay, the country can go more in debt. That's great for financial markets. They did raise the debt ceiling just a couple of months till December. We'll go through this whole dance again very shortly. And all this is contributing to the inflation. Now, I'm seeing a lot of new clients. You guys, my listeners, who are coming to me who are very concerned about inflation. It's really one of the top things that we're discussing now in our first appointments with new clients. And I'm not bringing it up. They are. And a lot of people coming to me saying, Lou, what could I do with some of my money to protect me against inflation? And the problem that we have is that conservative money that are in savings accounts, CDs, bonds, they're not getting enough return to keep pace with inflation because of the Federal Reserve's low interest rate, zero interest rate policy. So they have a negative real rate of return. I've explained that before in this program. A negative real rate of return simply means that the interest or yield that you're getting on your savings and investments are lower than the inflation rate. That's a negative real rate of return, and it's a real big problem, especially if you stay there over time, because you compound the loss of purchasing power. And you talk about, say you're lucky to get a half of 1%. Let's say 1%, which you can't get in most savings accounts. Well, let's say you can. Well, if inflation, the official rate, the CPI, is around 6%, a little under, well, you're losing 5% in real purchasing power. But if you take a look at the real inflation rate, which is usually double what the government tells you it is, now we're looking at 12%. So if you're getting 1% on your money and price of everything's going up 12%, you've just lost 11%. Not in real dollars, but in purchasing power dollars. And that's a real problem. It's called going broke safely. That's what it is. It's going broke safely. You're afraid to go into the stock market and other risky investments, but you lose it to inflation. And this is what's happening, certainly here in the United States, but it's all over the world. And it's especially problematic for low-income people, third world countries, that don't have any wiggle room in their budget. So some people can benefit by inflation. Certain investors can look, and that's what we're doing for a lot of clients that come to us and say, "Lou, I'm worried about inflation. What could I do?" All right, well, I put together an inflation-resistant portfolio of things that we can invest in that should keep pace with inflation, if not exceed it, to give you a real rate of return at minimal of zero. Zero means that you've kept pace with inflation. If inflation's 6, you earn 6, you have a real rate of return of 0. Your purchasing power remained the same year over year. So what do you do? Well, the first place is gold. I mean, we always talk about that, and gold and silver as the hedge against inflation. It has been for 5,000 years. It will continue to be. It's heavily manipulated and suppressed, so it's not doing what it should be doing, given the inflation that we're dealing with now. Gold should be 2 to 3 times where it's trading right now, but it will. So a lot of people ask me, all right, Lou, how do you buy gold? Some people have asked me, you should do a segment on the show. You could do a whole show on gold and how to buy it, how to sell it, and what it really does. And for thousands of years, humans have coveted gold. And today's investors are no exception, especially governments too. I mean, China, Russia, they're all buying gold like crazy. So how can you buy gold? Well, if you want to buy physical gold, which is called bullion, not chicken bullion, not beef bullion, gold bullion. Bullion's a term for pure metal quality. And you could buy it in the form of coins. You could buy it in bars. If you go away from bullion, you could also invest in gold by buying gold-backed securities, trusts that own gold. So by buying shares of that, you indirectly own gold. You could buy gold mining companies, which benefit by the rise in the price of gold. Gold is also considered a safe haven asset, because when prices of other investments, like stocks or real estate, drop sharply, gold usually holds its value, if not rise. And the reason it rises sometimes in that environment is that scared investors rush to buy it as a protective hedge. And experts have always said they see gold as the ultimate way to protect your savings against rising prices, that real rate of return issue we just talked about. And it's held its value for hundreds of years. There's an old adage that in 1935, an ounce of gold would buy a fine man's suit. And today, that's exactly the same case. So that's what you call preservation of wealth. And that's why people invest in gold. So how do you do it? All right. Well, first of all, most financial planners say you shouldn't put more than 10 to 15% of your assets in gold. And I advise clients that too. But having said that, in my own personal life, it's much higher. And the reason why I tell you that is because I want you to understand my conviction of what's going to happen to the U.S. dollar, what's going to happen with inflation. And I've been a gold investor for a very long time, so it's not something I just started now. And it's served me very, very well over the time frame. It's preserved my wealth. It's kept pace with inflation, if not better. So the first way you buy it is physical. Holding it in your hand. That's always the best way to own gold or silver. In your hand, there's no counterparty risk. What do I mean by counterparty risk? If you don't have it in your hand, someone has to give it to you. So if you buy it somewhere and they're holding it for you in some account somewhere, they got to give it to you. And you don't know if it's really in that account. If you buy a futures contract, which I'll talk about in a second, somebody has to deliver to you and satisfy the contract at some time in the future, which they may not be able to do. So having it in hand means that you have it. You don't have to worry about anybody giving it to you. You don't have to worry about a collapse of any financial institution that's holding it. It's portable, it's private, and that's the best way to do it. But the problem that people have is that, what if I have all my money in a 401k or an IRA account? I'd have a big tax problem if I take the money out and I have to pay tax on it to buy gold coins. Now, there's gold dealers out there that say you can have a gold-backed IRA. I still don't really fully understand how that works because you don't really actually have the gold. You have a claim on gold. But it's not the same as holding bars or coins in your hand. So where do you buy it? Well, there's a number of places to buy gold. You could buy it from a dealer, either online or a local coin dealer. But the one thing about a local coin dealer is you can have a personal relationship with that person or that company. You can walk in and talk. And that's the way I pretty much buy my gold, is I like to do it with a local dealer. You could buy it online. You see all the commercials, especially on Fox, about the importance of owning gold. They have all the old actors who are washed up, who do commercials now to make a living pushing it. And rightfully so. I mean, I'm not saying they're wrong in doing it, but I'm just saying is that these are the dealers online. The Lear Capital, the Gold Line, you can go on and on. AppMex is an internet-based one, and they're fine to buy from. I mean, there's no concern. A lot of people have concern that, hey, if I buy gold, how do I know I'm getting XYZ? If you're buying coins, there's really little concern. Coins are very, very, very hard to counterfeit. They're very, very intricately minted. It'd be almost impossible to counterfeit gold coins. So if you're out there looking for like an American Eagle 1 ounce gold coin, you're going to get an American Eagle 1 ounce gold coin. No question in my mind. The question now is, what am I paying for it? Because when you buy it, there's a premium attached. The gold dealer has to make money. And that's called the premium. There's something called the spot price, and then there's the actual price that you would actually buy it. Now, the spot price is based on the COMEX, the Commodities exchange, the futures market. And this is the place where the market is manipulated. This is where the JP Morgans of the world and the Goldman Sachses and all the gold dealers can basically short millions and millions of ounces of gold with paper, with never having to deliver the gold itself. So if you wanted to push down the price of gold, all you do is sell half a year's worth of gold production, mine production, in 10 minutes, and you can push the market down $50 an ounce. And then you just buy it back in the futures, you cover the short position, you make a profit. It happens every day. It's been going on for 25 years, maybe longer. It's a racket. It's criminal. But the government looks the other way because they don't want gold and silver going up. Because that means that there's a loss of confidence in the currency. So let's look at what's going on right now. The first thing you want to do is you want to look at the spot price. And you can get that anywhere. You can go on CNBC, Fox Business. is a place called Kitco, KITCO.com. That's a gold dealer. They always have the chart of the gold price at the moment. And you can see the silver price there, the platinum price, what have you. Then you go to these websites or you call the dealer and say, what would you sell me? An ounce of gold or an ounce of silver. And you don't have to buy an ounce. You could buy fractions of ounces of gold. You could buy 1/10 of an ounce of gold. You could buy a half ounce of gold. You don't have to buy a full ounce. There's even some internet sites where you could buy grams. And it's like a bank account. You just buy and sell grams of gold. So right now, the price of gold on the spot market, which is the COMEX market close on Friday, is $1,765 an ounce. Now, if you go to Ampex, I went there this morning just to see what their prices are, you're going to pay $1,875 for a 1 ounce American Eagle gold coin, random year. So that's a 6% premium. And that's customary, that's normal. So if I was looking to buy a 1 ounce gold coin, I would think that that's a very reasonable price, very, very competitive, and very, very custom to pay 6%. And I would feel very comfortable buying that. Now, if you went to a 2021, a newly minted coin, you're going to pay a little bit more for that. Instead of paying $18.75 an ounce, you're going to pay $19.45. Some people desire the most recent coins, so they're in higher demand. So in this case, that's a 10% premium. Now let's take a look at silver, because silver is a totally different animal. Silver is so undervalued compared to gold that would be my metal of choice, especially if I wasn't putting tens or hundreds of thousands of dollars in it. Silver is what I would look at, because silver really has tremendous upside potential as a percentage gain compared to gold. Now historically, it takes 25 ounces of silver to buy 1 ounce of gold. Right now it's in the 70s. It takes 70-something ounces of silver to buy an ounce of gold. And that's historically high. So even if it goes back to the normal ratio, I mean, silver could take off with gold not even moving. And silver is the poor man's gold. People can afford it. But let's look at the premiums in silver. On Friday, silver closed at $22.80 an ounce. You can buy a 1 ounce silver coin, at least at APMEX, which is a very, very liquid, very, very large dealer. You can't buy it for less than $32.59. That's almost $10 more. That's 43% premium. Now, I just told you, gold you could buy for a 6% premium. Right now, it costs you a 43% premium to buy silver. So that just tells you of what the real market in silver is. The real market is where you can get the metal, not what the futures market says it is. And by the way, silver is more manipulated than gold. Always has been. I would still pay $32.59 for an ounce of silver. Not because, well, why would you buy it at $32.59 when it's only $22.80 in the spot market? The spot market is fictional. I always look at a market as, what does it take for me to get it? What does it cost me to buy that item? Not what some futures market says it is. And the market right now, and it has been this way for some time, silver has been in the 30s, while the spot market has had it in the 20s. So big, big premium in silver, 43%. Still a good buy, because it's going to be 100, it's going to be 200. And it doesn't matter if you paid $32 or $28, it doesn't really matter at the end of the day. Now, many people, they don't buy it all at one time. They'll buy a little bit at a time and you build up a position. It's easier to do. Like if you're paying $30-something for a coin, maybe you could buy 3 or 4 every month for just a little over $100. At least you get started that way. So whether you buy it from an online dealer, you buy it from a local dealer, coin dealer, it doesn't really matter as long as you know what the premium is. and compare it to other dealers. And that's what a lot of people do. They'll say, okay, I know what the spot market is. You can see that anywhere. But let me see what the premiums are in different places. Now, I went on Kiko's website this morning. They were out of stock on almost everything. And that's another problem you have with the metals market. There is times you cannot get it. And that's the case with silver, especially right now. And many, many dealers don't have any at any price. So you got to be aware of that when you're shopping. Now, some people like to buy a lot at one time. So how do you buy a lot? Well, there's something called a monster box. A monster box comes from the U.S. Mint. And by the way, mints are the ones who make the coins, obviously. And a monster box is 500 ounces. Right now, you could buy a monster box at APMEX for $16,100, which comes to $32.20 a coin. Again, a monster premium for a monster box. You could also buy ingots. I have bought in the past 5-ounce ingots of silver. So instead of buying a 1-ounce coin, you buy a 5-ounce little bar. It doesn't really matter how you buy it. 5 ounces of silver is 5 ounces of silver, whether it's a American Eagle or it's a bar. Makes no difference. The main thing is that these bullion gold and silver are 99.5% pure. Pure gold, pure silver. The problem with gold bars, and I'm not talking about small ones, the problem we've seen in the marketplace, especially for the 400-ounce bars. Now, 400-ounce gold bar, I mean, think about how much money that is. It's like $800,000, a little less. But those are the bars that central banks deal with and trade and all that. When you think Fort Knox, there was one day that we had gold bars there. There's a lot of debate whether or not there's any there now, because nobody's seen it in 70 years. My guess is it's not there. There was some counterfeiting going on with the bars, because the bars are much easier to counterfeit, because the way they do it is they use tungsten. Tungsten has the same weight basically as gold. So they would take tungsten and then plate it with gold. So there'd be a very, very small fraction of gold in it. So when they drill into these bars, when they do assays of them, they were coming up with tungsten. I haven't heard much of that recently, but it was happening in coin dealers and gold dealers in New York City a couple of years ago. Now, when you buy a coin, it's actually a legal tender. If you buy an American Gold Eagle, you could actually use it in the store to buy something. Now, you'd be stupid if you did, because the face value of a 1-ounce American Eagle gold coin is $50. When the real value is $1,765. So, I mean, if you went and used that coin to spend $50, you'd be an idiot. So people won't do that. The reason why you buy the coin is you're never going to use it to buy something. You're going to use it to convert into either dollars or yen or euros or something else, or into some other currency. So there's different types of coins you could buy. The most popular here in the United States is called the American Eagle. But you could buy gold buffaloes. You could buy Canadian maple leafs. You could buy South African Krugerrands. Almost every country has their own mint of coin. One of my favorites is the Vienna Philharmonic. Beautiful instruments and everything. These coins are very pretty. And these coins range in size from 1/10 of an ounce to an ounce. And that's my preference of buying gold and silver is coins, because you could buy small amounts at a time. Let's talk about gold-backed securities. These are also known as trusts, ETFs, or what have you. And this is a way, like I said, through retirement plans or through a portfolio of securities to own gold. And that is trusts that own the actual bullion. They have every bar. It's audited. It's kept in a vault in a bank somewhere, and you buy shares of that fund. Now, the only thing that fund does is own gold or own silver or own platinum. So by owning shares of that fund, you're going to have pretty much the exact return that the metal itself has, because by indirectly you own it. Gold goes up 20%, a gold ETF will go up 20%. Gold goes down 20%, the shares of a gold ETF will go down 20%. But they're very liquid. There's no premium or anything like that. So it's a way of trading gold. Some people like to trade it. I do that sometimes in my brokerage account. I'll buy a gold or silver ETF, not looking to hold it long term as my financial life insurance or as my inflation hedge, just a trade. I see that it's undervalued. My charts are telling me it may have a pop here. I'll buy it and then sell it at the appropriate time. One of the people asked me, what do I like? The gold ETF I like is the Sprott Gold Physical Gold Fund. Symbol PHYS as in physical. That's the symbol on the exchange. The silver I like is the Aberdeen Standard Silver Fund, Physical Fund. Symbol SIVR. And there's a platinum fund I like too, the Aberdeen Platinum, the Standard Platinum Fund. I forgot the symbol on that one. And you can also buy gold mutual funds. A gold mutual fund will typically invest in a portfolio of mining companies. Well, why would I want to buy gold mining companies? Well, if gold's going up, the profits of a mining company is going to go up. If silver's going up and I'm a silver miner, it doesn't cost me any more to dig the hole to get the silver out of it. But if it goes up $1 an ounce, that's $1 of pure profit on my balance sheet. So gold stocks and silver stocks and miners are very leveraged to the price of metal. And if gold goes up 20%, typically a gold mining company will go up 3 times, 60%, because of that leverage. Now, it's a double-edged sword. It works both ways as well. Some of the bigger gold mining stocks, see, I'd prefer to buy a fund or an ETF because it gives me diversification. I don't have all my money in one gold miner because things happen in the gold mining industry. Country risk. Me and my clients were big investors in a Venezuelan mining company. Long story. And then Chavez expropriated the mine to Venezuela, and we got screwed. So you have to worry about that kind of risk. And there's also other environmental risks and everything else. That's why you want a portfolio of them. Biggest ones are Barrick Gold, Newmont Corp, Kinross, Anglo Gold. These are all big mining companies if you're looking at individual stocks. Before I mentioned the gold funds that'll buy a mixture of many different gold companies, gold miners. Some of the better ones out there are Fidelity Select Gold portfolio. You could buy Gabelli Gold Fund. You could buy USAA Precious Metals and Minerals Fund. Franklin also has a gold fund. So they're easy to get. Most mutual fund companies have gold funds. But just remember, you're not buying gold. You're buying stocks in mining companies. So you are investing in the stock market. What are some of the other things you could do to hedge against inflation? Well, there's exchange-traded funds that invest in commodities or commodity futures. One I like to use is Invesco DB Agricultural Fund. DBA is the symbol. That has mainly food commodities, grains, meats. We were talking earlier about the price of meat and the price of food going up tremendously. Boy, that fund has done really well. And it should. It owns futures contracts in all these commodities that are going up. And just remember, commodities are things. It is food. It is energy. That's another one. I mean, we see oil prices continue to rise. Natural gas prices going through the moon. I was driving into the studio today. New high on gasoline. $3.34 on the Parkway. Highest price I've seen in a long, long time. What is energy prices up this year? What is it, something like 40%? Gasoline prices. Natural gas is going to, I think natural gas went up like 40 or 50% this week in Europe. This week. Lebanon, countrywide blackout for 2 days now, and they don't know when they'll be able to put the lights back on. You know why? They can't get fuel to power their power plants. Supply chain issues again, and costs. So buying things. We said that inflation means the price of things go up as the value of currency goes down. And whether that thing is an ounce of gold, an ounce of silver, a barrel of oil, corn, grains, hogs, those things all go up in inflation. And that's the way to inflate and protect your money in an inflationary environment. So anybody that's interested that want to look for an inflation portfolio, come see me. I'll show you how to put one together. Now you got to understand, when you're in commodities, when you're in gold, it's volatile. It's not a savings account. You're going to have significant swings because that's the nature of commodities. They go up and down a lot. But if you think inflation's here to stay, if you think that the U.S. dollar is going to continue to evaporate in value as we continue to print and borrow, then you would want to be there over the long term. Short term, you're going to have all kinds of volatility, and you have to be able to stomach it. And a lot of people don't have that risk tolerance to stomach that. Then it's not for you. Another thing in inflation that many of us are seeing right now, one of the good things to have is real estate. I mean, we've never seen anything like we see happening now in the real estate market. People paying tens of thousands of dollars over the listing price. When have you ever heard that in your life? The person who listed their house always expected to be bargained down. And now it's just the opposite. People are getting 5 offers. My brother just told me he sold a house recently. In 2 days it was sold. 5 offers. And with that, we're seeing increasing price inflation in housing. And we're seeing it in the price of housing, and we're also seeing it in the cost of rental apartments and homes. It's skyrocketing. So many of us do have inflation protection in our life. It's called our home. I know my model that I live in, my house, I couldn't believe the prices that some of them were selling at in my community. So I had a real positive, real rate of return in that asset. But we're not all going to go out and buy multiple homes. I mean, most people can't afford to do that. But at least you have your own home if you own it. Inflation protection. Inflation protection simply means owning real stuff and not owning paper. And if you have a savings account, you own paper. And that's why that negative real rate of return is really, really bothersome to a lot of people. And it's not going to go away anytime soon. All right, let's take a break. 732-505-1160 is the call number. My name's Lou Scatigna. Don't go away.